Hey everyone, Dave Allison, and in today's video, we're going to be talking all about the risk-free rate of return. Now, the risk-free rate of return is an incredibly important number when we're doing things like valuing stocks, companies, or other investments. One of the most well-known valuation methodologies is this capital asset pricing model. And you can see here this kind of big R, little f, that stands for the risk-free rate of return. It's also used when we look at what risk premiums we should anticipate on investments. So this is the premium or the return we should expect for taking on risk. Now, we're not going to talk about valuation in today's video. I want to talk about some practical things that you could use today, which is how to get or earn a better rate of return on your cash or the money that you just don't want to put at risk in the stock market. And so why this is important is if we look at some numbers, April 21st of 2020, the risk-free rate of return, which is known as the 10-year Treasury bond or T-bond, is issued by the federal government. It's a bond. And essentially in 2020, it would pay you 0.58% interest, and that was guaranteed for a 10-year time period. Not a very attractive interest rate. Well, if we fast forward to March of 2023, that same 10-year bond is now paying 3.97% guaranteed for 10 years, guaranteed by the federal government. Again, 3.97% is a little bit more attractive than 0.58%. But for a lot of us, we don't want to lock our money up for a 10-year time period. And so the federal government offers shorter term bonds. They offer things in duration of 13 weeks or 26 weeks or 1 year, 2 year, and so on and so forth. So just to give you an example of where interest rates are at right now, the 26-week Treasury here at its last auction had an interest rate of 5.183%. So again, if you had cash on the sidelines, not earning much, or if you wanted to take some market risk off the table, but not have that money sitting around earning zero, you could commit to buying a 26-week T-bill and essentially earn over 5%. And in many cases, if you're in a state that has a state income tax, that interest is state income tax free as well. So again, the purpose of this video is to share that although this interest rate cycle has hurt stock valuations, and that goes into that capital asset pricing model, although it's hurt borrowers, higher mortgage rates and loan rates, it has helped the saver. Instead of earning zero at the bank, we now have options to help at least produce a little more risk-free interest on our investments, utilizing these things like 13-week, 26-week, 52-week, or even longer duration government bonds. So if you have any questions, please don't hesitate to reach out and again, take advantage of the interest rate hikes that we've seen for your own personal savings.